connecting investors, financial institutions, and businesses around the world. Luxembourg is a center of excellence for global finance. Recognized for its unique international financial expertise, Luxembourg is solution-driven, stable, and open to innovation. A pioneer and global leader in sustainable finance, we help build a better tomorrow today. An international financial center and a European capital. Luxembourg is an exceptional and welcoming place to work and live. Discover what we can do for you.
Welcome to the Sustainable Finance Forum, bringing together key sustainable finance experts from across the world to share their views on how finance can shape a sustainable future.
Ladies and gentlemen, good morning, good afternoon, and good evening. Wherever you are in the world, a warm welcome back to the second day of the 2024 edition of the Sustainable Finance Forum. My name is Judit Bogner, and once again, I'm honored and delighted to lead you through the second half on behalf of Luxembourg for Finance. Quick reminder, this will again be recorded, and just look for your inbox. There will be an email once we wrapped later today with the direct link to the recording. And again, if you happen to post something on LinkedIn or on X about the event, please be sure to add the handle @LuxFinance so we can all see your comments. Now, to pick up the thread, let me start by summarizing a few takeaways from yesterday that will also feature in today's conversations. The now third report by New Financial, sponsored by Luxembourg for Finance, holds up a mirror on climate commitment versus climate action with a reality check on green finance. Now, the good news is that European capital markets have raised almost 1.5 trillion euros in green finance over the years 2019 until 2023, averaging 360 billion euros for the past 3 years. Not so good news were that this growth seems to be running out of steam, with the value of activity flatlining in the past few years. And too much capital is still being raised to finance business as usual by those so-called bad or brown companies whose activities actually delay the decarbonizing of the economy. Also, there has been a political pushback against the green agenda, and there are concerns that the regulatory framework might have become too burdensome and complex. Now, against this reality check, Mark Carney issued a succinct and urgent call and laid out what it takes to build a sustainable financial system as a centerpiece for a net zero economy. And that is closing 3 gaps: data, action planning, and investment. And in that vein, His Excellency Minister Roth launched his 10-point Sustainable Finance Action Plan that is designed to strengthen Luxembourg as a sustainable finance hub. It includes also the intention to go beyond green, to position Luxembourg also in the field of biodiversity and nature capital finance, as well as a center of excellence for gender finance. Now, from the panel on engagement and stewardship on the path to net zero, we heard that the new disclosure standards, I will talk about those also today, such as CSRD, help to engage and communicate with companies on their transition planning. That said, challenges do arise for those financial firms that operate in different regions with diverging standards. So there was very much a call for consistency and harmonizing of standards between different regions. And today we'll continue that conversation by indeed looking at the efforts to mitigate regulatory fragmentation between different parts of the world. We look at how the EU's sustainable finance regulatory architecture is likely to evolve, bearing in mind that we'll be under a new commission after the EU elections in June this year. And we'll also look in this context at the support for transition finance. And we'll investigate how innovative technologies such as AI and blockchain may help to resolve some of the problems, the challenges, and what the caveats may be. But first, we will talk about impact investing. According to the Global Impact Investing Network, the market for impact investing surpassed the milestone of $1 trillion assets under management back in December 2021. Now, in March this year, the GIN described in our quote a consistent momentum of significant impact investing commitments from institutional asset owners. That said, we know that 2023 saw a big drop in venture capital flowing into impact startups. And despite the efforts of many committed capital providers, the gap to achieve the United Nations SDGs has actually grown to $4 trillion annually. That's up from $2.5 trillion back in 2015. So this highlights the need to go back to the drawing board, to think about how to mobilize more resources to address those growing concerns that are arising due to social and environmental challenges. And the question is, why is this momentum not strong enough? And what are maybe the misconceptions that are in the way? This is what I'm going to address with my first guest today, Olli Grabenwarter from the European Investment Fund. And I have Olli Grabenwarter here with me in the studio live. What a pleasure. Warm welcome to the Sustainable Finance Forum, the 2024 edition. And just to give our audience a bit of an idea what your background is and how long you've been involved in impact investing. So since January this year, you're the Director for Equity Investment at the EIF. Prior to that, you were the Deputy Director since 2012, and you've been in various other positions at the EIF, actually joining the EIF back in 1995. And you are responsible for the EIF's strategic development in the equity space. And in this context, you've also been part of building up the social impact accelerator. And your current responsibilities include the EIF's activities in venture capital impact investing and in the technology transfer with, for our international audience, not everyone may know that, but the EIF is Europe's biggest fund investment platform in these markets. But you also have another side. You enjoy teaching. You have a closer relationship with the IESE University in Barcelona, where you're a visiting professor for private equity and venture capital. And you're also an angel investor in the area of life sciences, which is your passion. So you come with a rich background to this topic, impact investing. Again, a warm welcome. Good to have you with us.
Good morning, Judit.
So it was your choice to use the title Impact Investing. It's time to move out of denial. It actually dovetails with a YouTube, available in YouTube, a TEDx talk that you did about why impact investing doesn't work anymore. So why does it not work anymore? Why is it time to move out of denial?
Well, it is true that recently I take this slightly critical or provocative stance in framing my thoughts on impact investing, because I think impact investing is now in the market for something like 2 decades. We have probably seen a few ups and downs, but in general terms, we see a big momentum for impact investing. It is all over the place in the press and in the media. But I think after 2 decades, it is about time to ask ourselves, to make a stock take and ask ourselves what we have achieved. And what do we use to measure the success of impact in broader terms? And we need to ask ourselves the question of whether it is indeed accurate to measure the success of impact by measuring the assets under management, or whether we measure the success of impact by proving that there is no trade-off between financial return and impact. And you mentioned in your introduction today the SDGs, and actually if we take a retro perspective of the SDG targets that have been defined in 2015, and at that time we actually assessed that we needed something like $30 trillion of incremental investment in sustainable finance and impact investing in order to reach the SDGs. Now, if we look at the journey that we've done since, in the last 10 years, we have not exactly matched the proportional amount of the 30 trillion that we ought to raise, but we have almost managed to raise this amount of funding. Yet today, if we look at where we stand, we need to realize that we are further away from reaching the SDGs than ever before.
It seems like the goal is running away.
And we have less time to get there.
Yeah.
So we need to possibly admit that something must have gone wrong.
So what needs to change?
Well, I think if we look at the approach that we take to the world of finance and impact finance in particular, and also if we relate it to the planetary system, I think we make basically three major mental mistakes in dealing with this space. The first one is that we consider our societal system being outside the planetary system. And when we reason about the sustainability of our society, we believe that it is enough to fix the planetary system, that the societal system that we are living in is basically okay. We just need to find a way to adapt the planetary system in a way that it can maintain our societal system going. And I think that is a major flaw in thinking, because frankly speaking, if you look at it from the perspective of the planetary system, humankind is dispensable. We are not system critical.
Good point.
Even if temperatures rise by 5 or 10 degrees, there will be life on this planet. It just may not be human life that will be there. So this is one of the concepts that I think we finally need to get to grip. Secondly, I think the other dimension we have is that when it comes to recognizing that we need to do something about our societal system, it is a question of who takes the responsibility for. And we have a very comfortable default attitude as human beings to say that yes, something needs to be done, but it's not me. Somebody else will take care of it. Be it the regulator, be it the financial markets, be it the consumers, be it enterprises that are in the market, you name them. And this is this kind of mechanism of delegation of responsibility that has brought us to procrastinating actually in a situation that is no longer sustainable. And the third one is when we finally come to the conclusion that it might be us ourselves that have to do something, that we think that it is effortless. We do believe in this concept of assuming that there is indeed no trade-off between financial return, between economic wealth, between maximizing of economic wealth, and the impact that we need to achieve to save our planet.
You could say we try to imagine it's pain-free.
It's pain-free, and that is a big illusion. That is a big illusion because we have gone through this cycle of thinking that if we invest just a little bit more responsibly, everything will fall in place. Clearly, it does not.
You're making a business case for survival.
It's a paradoxon, actually, that we think that we need a business case for survival. It should be honestly something that becomes self-evident that we ought to take action if our own existence is threatened. But yet, we go about impact investing as being something which is utterly opportunistic. As long as it fits into a risk-return spectrum that we believe is compatible with our economic return generation that we assume that we need in order to sustain our life cycle. As long as investment opportunities fall in that spectrum, they are okay. As soon as they fall outside that spectrum, somebody else needs to take care of that. And in a way, the call of action that we actually have to face today is that we need to move out of this opportunistic impact investing that limits our impact only to the impact that would have happened anyways, and to go to see how we can address the uncomfortable impact that actually is necessary and pivotal for our survival, but today does not find financing.
So what I'm hearing is you would propose to turn the process on its head, think backwards from the problems towards the solution, and then develop the financial instruments that are needed to get there, to fix the problems. And allow me to just to throw in something that Marcani spelled out yesterday, which I thought very, very interesting and insightful, and it ties in with our conversation. He spoke about the paradox of prudence, that in the financial sector we see that firms are microprudentially very smart about minimizing risks that are related to various projects, but then macroprudentially prudent by financing a systemic problem to the extent that we see as the climate crisis or biodiversity damage or other issues that we tie in with sustainability. That goes back to what you're saying.
Absolutely, and I think the problem that we are facing is that we are still busy with trying to bring impact to money.
Yeah.
Where it is convenient to be a selling proposition to customers, private banking clients, and whoever wants to engage with the so-called opportunistic impact investment space. But we haven't actually found a way of bringing money to the impact that is needed. And in a way, this has some history of a mind shift that we have been going through over the last 2 decades, but very slowly. We finally at the stage that we probably recognize that we need to integrate externalities in our business cycles, that we need to integrate one way or the other the cost that we bring to society by depleting natural resources, by polluting atmosphere, water reserves and things like that. We have not wholeheartedly taken that on, but this is something that starts sinking in. The element that we have so far not gotten to is to integrate the positive societal value that is created into the business cycle, in a sense that it actually is rewarded by consumers, by taxpayers, by the society at large. Whenever there is positive impact and positive value that is created to society, that this actually has a monetary and an economic value as well.
Well, it occurred to me as I was listening to the efforts being made now to meet the disclosure requirements around the world, in the European Union and elsewhere, and listening to what Professor Shiva Rajgopal yesterday said, again, as you say, about internalizing external costs as well, the positive and the negative, that there seems to be just a small step from doing this exercise of gathering the data for the disclosure to taking into account those positive and negative costs, impacts that you are referring to. Would you see that also?
Yes, absolutely. If you look at it from the perspective of the business cycles and the value creation that we have got in businesses, the fact that we are not ready to pay for the positive value has tremendous implications. Take the example of the farming community.
Yeah, big issue.
We have this attitude as consumers that we are ready to pay exclusively for the production cost of a farming product unit. And yet, if we look at the societal value that is created alongside, or actually the environmental damage that is created with wrong type of agriculture, there is a choice to be made. Mm-hmm. And we currently are in a situation, especially in Europe, where we have recognized the value of our ecosystems and soils and natural resources and the like, and are moving towards efforts to make agriculture more sustainable.
Can you give a concrete example?
The concrete example is that we are currently, and actually you can see it in the protests that are taking place in the streets of pretty much every capital city in Europe by farmers right away. We are at the point where we discuss what legislation do we need to introduce in our agricultural system in order to protect natural resources. The mistake that we are making is that we are actually asking a farming community that already has virtually no margin to secure its own survival to shoulder the cost for this type of measures in order to preserve our natural resources, without actually asking us as a consumer to pay for the additional value that is created by the farming community. And I think that is the point in time where we need to reflect on a different perspective in that respect.
So do you have a concrete example, for example, investing in in regeneration of soil that shows very clearly in the data the volume that's needed to invest, and that versus the positive impact it has, say, in GDP terms.
Yes, there are studies ongoing, and actually even projects ongoing in regions in Europe, like in the region close to Bodensee, where actually they have been calculating how much it would take to remunerate the farmer community in order to run an agriculture that is actually sustainable with our protection of natural resources. And this actually would cost a couple of tens of million of euros on a yearly basis, but would be offset by a GDP growth that is contributed by this community in the magnitude of 11 billion. And if you see this relation, there's something that is in the economics is not right.
So coming back to the MDBs, which the EIF is, of course, Makani also referred to the MDBs that they can do a better job to carry some of the risk that at the moment the private sector would not take. What is your perspective on that?
Well, I think it is definitely a evolution, an unfortunate evolution that we have taken with our financial systems, including with the MDBs. That we have basically forced them to operate within the framework and within the risk concept of a normal commercial bank. And obviously that over time hinders the institutions to take any risk that is not taken anyways by normal commercial banks. And that has constrained the role that NDBs are playing in a kind of international context with respect to those pivotal impact objectives that we need to achieve. But I would say it is not the only way to get there. I mean, there are examples where MDBs actually have achieved with impact-centric investing huge paradigm shifts. For instance, the African Development Bank with the project of Desert to Power has brought about a impact of connecting 260 million people to renewable energy sources, and 60 million of those are for the first time in life to an electric energy grid. But it does not necessarily take the risk-taking capacity of DFIs to achieve that, because in terms of risk-taking capacity, we've got enough out there in the market. There are philanthropic organizations, there are foundations, there are states that actually engage as investors in impact finance with impact bonds and instruments like that. But the problem that we are having is that we are not using this power, we are not using this capacity of risk-taking for achieving impact, because we are not capable of using them in the context of blended finance.
So what does it take to mobilize it?
Well, first of all, I think the financial market community, rather than waiting for the perfect investment opportunity, ought to see the opportunity of engaging in that as a front runner. Mm-hmm. For the time being, we have very little incentive for the financial market community to engage in blended finance, because as long as you can actually sell plain vanilla impact investment products, opportunistic impact investment products that basically do not necessarily make a real difference, why would a financial institution engage in creating instruments that are designed to fund and to finance the uncomfortable, the inconvenient type of impact? But there's a fundamental flaw in the thinking that we can just sit and wait, and to be the free rider and wait that somebody else fixes the system and we are going to work on business as usual. Because if we actually wait for the system to flip, since we are all part of the system, it is not a question of whose fault it is that the system flipped. We will be collateral damage collectively and will be taken in the same trap. And if by any chance front runners will emerge around us that take on the responsibility and are successful in turning around the system, in creating an economic system that is reliant on regenerative cycles, they will take the market because they've been the front runners.
So Unfortunately, we're running out of time. Is there a call to action you would want to issue to your peers, whether that's the impact industry or private equity and venture capital industry, or to the financial industry in general?
Well, I think from the financial services industry, my biggest wish would be that we demonstrate that we have the intellectual capacity to think longer term than 12 months ahead.
Perfect point to end on. Thank you so much. It's been truly a pleasure. Uli Grabenwarter there from the European Investment Fund. And we will carry on picking up some of the themes and talking about the challenges that have been raised in the conversations yesterday for scaling up sustainable finance. And those are two. One, the fragmented landscape of sustainability-linked regulation and frameworks across different parts of the world. Remember, I said the Climate Bond Initiative speaks of 40 at the moment, 40 taxonomies worldwide, and the need for high quality, standardized and consistent sustainability reporting by companies that meet the information requirements in the financial sector. Now, yesterday, Mark Carney highlighted the work of the International Sustainability Standards Board, the ISSB, whose inaugural standards apply to annual reports from this year onwards. Now, for our international audience, some of you may not be aware, the equivalent for companies in the European Union are the European Sustainability Reporting Standards, ESRS, that go hand in hand with the new directive, the Corporate Sustainability Reporting Directive, CSRD, and together they broaden EU sustainability reporting for most companies and also apply from this year onwards. You heard several of our participants talking about now the gathering of data for meeting these requirements has started for them in earnest. There is one key difference that keeps stirring up debate and controversy. And that is the ISSB standards are restricted to financial materiality, and the ESRS standards base their materiality assessment on the concept of a double materiality. So bear this in mind as we go into our next keynote. And to elaborate on the regulatory efforts to mitigate fragmentation in sustainable finance, I have the pleasure to welcome our next keynote speaker. He's the chair of IOSCO, short for International Organization of Securities Commissions, which unites over 130 authorities regulating some 95% of a global financial market. He was elected to this role in October 2022 after serving as vice chair for the previous 6 years between 2017 and 2023. He also served as the chair of the IFRS Foundation Monitoring Board. Besides his international responsibilities, he's also the chair of the Belgian Financial Services and Markets Authority, FSMA, since 2011. In this capacity, he's also a board member of several supervisory boards for the financial sector, including the European Securities and Markets Authorities, ESMA, the European Systemic Risk Board, and the College of Euronext Regulators. Please join me in offering a warm welcome to Jean-Paul Servais, who's joining us now from Brussels. Warm welcome to you, Jean-Paul. The floor is yours.
So, good morning, good afternoon, and good evening, ladies and gentlemen. First of all, Judit, allow me to thank you and your organization for the kind invitation and for having me on board, especially after so many distinguished speakers like the Luxembourg Minister of Finance and, of course, Mark. And I would like also to say that it's always a real pleasure for me to be back, even from a virtual point of view, in a country which I know very well, because it's just, I would say, not far from Belgium, Luxembourg, especially because I have also the pleasure to work with excellent colleagues from the Luxembourg CSSF, which are very professional supervisory body. Thank you also to you, Judith, for your kind words of introduction that I don't deserve. And I will come back, of course, as you rightly stressed in comment, on the comment made by Mark Carney, because I think that's what we are exactly doing at IOSCO level. It means that when we speak about sustainable finance, we have to speak about quality, quantity of data. First of all, we have also to speak about action, because we need to be doer if we want to be successful together in order to manage the fascinating, challenging, but also very positive journey about sustainable finance. And last but not least, we are doing work in order to be helpful, in order to finance the climate transition. Thank you also for having stressed, Judit, that I'm giving this comment in my capacity as IOSCO chair, which is, as you know, the international standard setting body for the regulation of financial markets. Yes, indeed, as you stressed rightly, Judit, we have 130 jurisdictions on board. And it means that all members are involved at national level in the supervision, ladies and gentlemen, of 95% of the supervision of the financial sector all around the world. National members, it means Luxembourg CSSF, it means UK FCA, it means the French IMF, the Dutch IFM, the German BaFin, the US CFTC and CC, the Japanese FSA. So we are a global membership organization. And I also have to say that we have a majority of growth and emerging market, which is, I think, very important when we take action about sustainable finance. It means, as you know, ladies and gentlemen, representative of the financial sector, that our members regulate and supervise stock exchanges, investment funds, banks, listed companies, brokers, insurance funds, and other type of financial institutions. Our role, and even if we don't have any kind of political legitimacy or rules, standards, papers, good and bad practices are non-binding, but are a source of reference, because everybody knows that whenever I have the pleasure, which happens very frequently, to reach a consensus with the support of all my colleagues, it means that you have the capacity to explain at national level that what you are proposing as supervisor is in fact supporting by a very large global community of financial supervisors. And our role at IOSCO is to develop global non-binding standards, which then can be fine-tuned, translated with more granularity, take into account some national specificity, but of course, taking into account the global picture. But it's also, I would say, part of our mission statement to monitor the implementation of these global standards and to promote adherence to our globally recognized standard for capital market. Today, and as agreed, and it's not a surprise for you because that's, I would say, the objective of this forum, about navigating global regulatory effort to mitigate fragmentation, sustainable finance. I will speak about sustainable finance. You could say, why IOSCO? And you would be maybe surprised if I say that I don't think, even if I'm well known, I think as a doer, a guy who puts very high, I would say, the agenda of IOSCO, I am not saying that IOSCO must be there for everything. There are excellent initiatives at national level. Look, I would say, how many people are attending this meeting in Luxembourg. So it means that the Luxembourg ecosystem is a very dynamic and very professional ecosystem. But I think that IOSCO must be there whenever we are speaking about global risk, challenges, and opportunity. And that's the reason why I had the pleasure, and thanks for having stressed that in November 2022 by all my board members and colleagues and friends. When I was elected, my first reaction was to say it's about speed, which is maybe something amazing coming from someone of the community of supervisors. But speed was important for me, and still important for me, because there is a momentum when we speak about crypto, NBFI, non-bank fashion, and sustainable finance. And that's what we did. In less than 2 years, we've been able to approve a toolkit for the sake of supervision of cross-border crypto asset service provider. The same with an excellent paper for one of our partnership with FSB about open-ended funds. And of course, last but not least, about sustainable finance. And that's the reason why I would like in 10 minutes to give you some detail about 4 leading important work managed by IOSCO. First one about sustainability-related disclosure. Second one, it's about related Asian standard, because it's a holistic approach. In order to avoid greenwashing, we need to have trust. So it means quality of financial reporting and sustainable reporting, but need also capacity for auditors to challenge the information proposed by issuer. Third aspect, transition plan, and of course, some limited comment about the financial integrity of carbon market. This being said, I have to remind that IOSCO and its member are not climate regulator. Let us be clear. We are financial market regulators, so it means that the starting point of all our initiatives, it's about you, ladies and gentlemen. If you are not only a professional investor and asset manager, a bank, but if you are also a private investor, like John and Mary in the street. And it means that we try to be helpful in order to provide and to give some explanation about the kind of information, material information, needed for investors to take decisions, take into account what they have to know, and in order to, I would say, to decide to invest in a company, in a financial body, which could be in line with your ESG expectation. And that's what we are doing, because we all know that we don't expect from the financial sector to find technological solutions in order to mitigate it, to avoid climate change. But we expect from the financial sector and from the supervisor that they could be helpful in order to channel savings to targets which are in line with the ESG expectations. In other words, it means that the capital market have a role to play in allowing companies to raise capital for their transition. And a prerequisite, therefore, is, and as rightly stressed before by Judit, is that investors have access to the right information to invest in this company. So this means, ladies and gentlemen, bringing sufficient trust and integrity into the marketplace so that the investor can make informed decisions about how to allocate their capital, and knowing that the likelihood of falling victim to greenwashing is reduced. That's a tricky issue. Let us be clear. It's about trust. I would always also have the pleasure to be the father of 4 kids. So I'm used to say that every day in my life, there is something to do about sustainable finance. But of course, the question I receive by definition from my own kids, the adults say, okay, but what are you doing about greenwashing? And that's exactly what we are doing in order to be helpful. And helpful, it means to avoid, ladies and gentlemen, that this issue could be addressed only at jurisdiction level. I think at IOSCO level that this issue requires the involvement of every jurisdiction. Collaboration is key, and that's the reason why IOSCO, which is a well-known global membership organization, can be helpful. And I appreciate, I have to say, the importance of my responsibility as IOSCO chair in developing solutions that are at the same time both ambitious enough to reach our joint objective and at the same time being scalable and proportionate so as to ensure that no one is too left behind and take into account regional specificities. Because let us be clear, I would say the journey about sustainable finance is a real fascinating, challenging, and I would say very positive one. It's part of my life. It doesn't happen frequently for people like me that the starting point, it's not about a crisis as such, financial crisis, which is not the case as such, I would say, for when we speak about climate. It's not in order to start with some recommendation coming from the European Commission, from FSB, G20, I would say a national supervisor. No, the starting point is about your expectation. It means retail investor, but also, of course, sophisticated investor. And what you would like to avoid is to be forced, to be required to play with a real alphabet soup of self-regulatory label and different frameworks. What you would like to have is only one global framework. And that's what we are doing at IOSCO level. And that's the reason why we decided, I would say, not 10 years ago, not 5 years ago, but only 2 years ago, to look for a partnership. And our choice was to try to convince, I would say, the IFRS Foundation, chaired by the excellent wise man Erkki Liikanen, former European Commissioner, former Minister of Finance, former Governor General of Finland, to convince him and the trustee of IFRS Foundation to take initiative because there was also, I would say, a successful track record, just for information, because I'm not sure that you know that. Already 25 years ago, IOSCO endorsed the famous accounting standard developed by another body, ISSB, under the umbrella of IFRS Foundation. And so that's the reason why I think that the story is a nice one, but not a very long story. Can you imagine, ladies and gentlemen, that over the past 3 years, since the establishment of ISSB, using the TCFD framework developed by McCartney, with the famous Bloomberg task force, which is a public-private partnership under the umbrella of the G20, can you imagine, ladies and gentlemen, that over the past year, since the establishment of the ISSB, at COP26 in Glasgow, much has been achieved in the area of sustainable disclosure over a very short period. And since Erkki Liikanen announced in Glasgow the famous, I would say, Finance Day, which is normally a Tuesday, at COP26-21, there were in fact two major news. The first one was the launch of GFED, also by McCartney, and the second one was the launch of ISSB by the IFRS Foundation, launched by Erkki Liikanen. And what does it mean? It means that in the meantime, they've been able to launch ISSB, to appoint an excellent chair, Emmanuel Faber, to find a Belgian compromise for multi-location, to draft prototype, to draft standards which have not been approved and endorsed by the ISSB in a minimum time. But it doesn't mean that you put a stamp in 1 month time. No, we start the work earlier by challenging the capacity of ISSB to deliver, I would say, standards which are ready, fit for purpose for the quality of information to be provided by the financial sector. So it means that in less than 3 years, we have been able to support, endorse, and be an incentive for this one. Is it normal, ladies and gentlemen? No, it's not normal. The speed is not normal. The speed is very high, I would say very intensive, because we know that there are expectations, because the aim of this work is to help issuer disclose more efficiently and effectively sustainability related risk, opportunities, and sustainability targets, and to meet the demand of investors. So what does it mean, the enforcement decision? It means that we think, without any political legitimacy, but as a community of global supervisors involved in, I would say, a vast majority of jurisdictions, we think that it can be an appropriate global framework for capital work. The fact that we were able last year in July to endorse this, it means that IOSCO called on jurisdiction to consider ways in which they might adopt, apply, or otherwise be informed by the ISSB framework to promote consistent and comparable climate-related and other sustainability-related disclosure for investors. And frankly speaking, of course, I'm not objective in my capacity as Council Chair, but I think it's rather realistic to say that I'm confident that this will put an end to the alphabet soup of climate disclosure. Because, ladies and gentlemen, according to some computation, we can expect at the end of the day that 130,000 companies, most of them listed, will apply, I would say, the ISSB standard. So that's the right answer to the question and the comment made, I would say, by Mark. It means, I would say, how to have data, how to avoid question about the quality of the data, how to avoid that there is no harmony. That's what we are doing. And the fact that we can expect 130,000 jurisdictions, 130,000, listed companies most of the time to apply these standards as endorsed by IOSCO is a real game changer. So it means that after on the endorsement, we are now involved in the implementation, and to be helpful for the implementation of these standards at the level of the different countries. And it means that a number of jurisdictions across continent are in the process of implementing the standards according to their national procedure, take into account countries' specific circumstances. I'm used to saying the most important for me is that the train left the station on time. But it doesn't mean that the size and the speed of all the trains across the different jurisdictions will be the same. Let us be clear. I would say the danger would be to think that we can be perfect in one day. I don't have to explain to people from the private that it can be a change in the business model of many companies. And your concern, your expectation are my expectation. I know also as chair of a national body what it means about know-how, about capacity to attract people able to understand this toolkit about sustainable finance reporting, but also about other aspects, asset management, and, for instance, ESG preference in rule of conduct. At the same time, let us be clear, I had the pleasure, as stressed by Judit, to see that in the EU, the SRS, the famous European Sustainable Reporting Standard, have come into force at the beginning of the year. And I have the pleasure to see, surprise, 10 days I would say mid-August, after the announcement by IOSCO in Brussels that we endorsed the ISSB standard, that there was an agreement between EFRAC, the European Commission, and the IFRS Foundation to find interoperability. Yes, I can tell you indeed that these European standards built on TCFD again, but also on the ISSB standard, achieve a high degree of interoperability with ISSB, which is to be welcomed. So it means 130,000 companies speaking more or less the same language, I would say with some different accent, let us be clear. It means 130 jurisdictions, including 45,000 companies using ECRS standards, which is now interoperable with ISSB standard. And we have, since the endorsement of ISSB standard, seen major jurisdictions like Brazil, Japan, Nigeria, Australia, Hong Kong, Singapore, and different provinces of Canada take important decisions for non-financial disclosure. ISSB standard will be required in some years in Brazil. The same in Nigeria. Another example, Japan just announced recently that they will implement new standards which are, I think, very close to ISSB standards. So I would say good news, and it's important to stress that because we need to maintain the strong momentum while recognizing that the transition will require significant change management and that company may face challenges in first-time application. Therefore, IOSCO is working with ISSB on a comprehensive capacity building program aimed at assisting regulators in their consideration of the use of ISSB standard. But it means also that we have to think about Asians, because disclosure needs to be trusted. If not, greenwashing. How to mitigate and to avoid greenwashing? To avoid multiple standards. That's fine. But we need to have the capacity to have on board external audits, having the capacity, the knowledge to challenge the information to be provided by issuer and asset management. And that's the reason also why we need global arrangement for independent agents of this disclosure. It means that I discussed that a lot with 2 independent audit standards setting boards in charge of updating the relevant international technical and ethical standards. Yes, by IWSSB, chaired by Gabriela Figueras and Tom Chen. So they accepted to update the work plan, and I have the pleasure, dear Judit, ladies and gentlemen, to tell you that they've made significant progress in recent months and are on track to finalize in time for the first set of 2024 audited report. It means also that no later than last week, the International Ethical Standards Board, IESBA, organized a seminar in my building in Brussels, in the FSMA premises, to discuss their consultation paper covering ethical consideration for assurance providers. So in fact, I didn't lie. I was not too optimistic when during my first speech after my election, less than 2 years ago, I said, we must be ready for the filing of the 2024 annual account if there is a decision taken about this at jurisdiction level. And that will be the case. We have a fully fledged global set of standards, ISSB, with interoperability with ESRS, and we have also a fully fledged set of Asian audit standards. So I would say the starting point is there. 2 last comments, if I may, Judith, in a nutshell. Transition plan. It's about, I would say, a proportionate step-by-step approach. First, to speak the same language. That's the case. Then to use that and to extract and to work on it through giant public-private, I would say, database like the NZDPU, a good example of public-private partnership, Macron/Bloomberg, one of the example about this. And it means that sustainability reporting, perhaps similarly to balance sheet and income statement and P&L and cash flow statement, only offer a snapshot of a company. But this is an important building block to have the capacity to use, to speak the same language that can be, I would say, analyzed with a lot of data to extract to the partnership. And then we switch to more data, more quality, many more data to be useful for, I would say, what we can do about scope 3. And at the end of the day, transition plan. Transition plan, if we want to believe in that, we need to be sure that we are using meaningful data. If not, it wouldn't be sufficient for investor interest in company with pledge to achieve some climate objective. And this is where the importance of transition plan comes in. What's the role of IOSCO? We are not climate regulator, let us be clear. So it means that we think that take into account the scope and the limit of our different national mission statement at international level, at national level, that as far as we are concerned, transition plan should provide investor with useful information about medium-term plans and the risk of opportunity associated with those plans. But this is realistic, again, only where transition plan provide accurate information and are comparable. Otherwise, they may foster greenwashing, thereby putting the integrity of sustainable finance at risk and eroding the trust in investors. What does it mean as far as IOSCO? That would be my last comment about transition plan. It means that 10 days ago, ladies and gentlemen, we published our revised work plan for this year, 2024, which includes a new work stream on transition plan, which will seek to contribute to our investor protection and market integrity mandate. Last but not least, VCM, voluntary carbon market. Let me just say a word about our work on voluntary carbon market. We published a consultation report during the last COP, COP28, about voluntary carbon market. I was surprised to say it was a reaction that everybody was welcoming. You know, when every time that we launch the initiative at national level, regional level, or international, we can expect pushback, question about proportionality, cost-benefit analysis, I would say a transitional period, and carve-out, and so on. This is not the case. Everybody is waiting for that. And we know why, because there are excellent projects about voluntary carbon market. There are other projects. How to distinguish good project from the other one. And that's the reason why, and also take into account the fact that voluntary carbon market or VCM have gained substantially in importance in recent years. But for this market to succeed, especially when we are upgrading this market at international level, this market needs integrity, both environment, which is outside the remit, and financial, which is inside the remit of our mission statement. And I believe IOSCO, in partnership with other SSB, like for instance the World Bank, and take into account our international market expertise, will be key in promoting financial integrity and the necessary trust to scale this market. With this, dear Judit, ladies and gentlemen, let me draw my opening remark to a close, and I would like to thank you, ladies and gentlemen, for your attention, and back to you, Judit, in your studio in Luxembourg.
Thank you kindly, Jean-Paul Servais, the chair of IOSCO. And Jean-Paul, I absolutely am sure that the market is appreciating the resolve and determination with which you meet the urgency of the moment. And I take away from your rich deep dive into the issue of mitigating regulatory fragmentation and sustainable finance that indeed the work that has been achieved over the last 2 years will put an end to, as you say, the alphabet soup of different standards around the world. And this will go down very well with all the participants that have spoken and are listening to this event. So thank you very much. And we're sending our regards from Luxembourg over to Brussels. Thank you, Jean-Paul.
Thank you.
Now, we'll carry on with something that was repeatedly mentioned as well. As William Wright outlined yesterday, ambitious regulation has been playing an important role in strengthening Europe's leadership in green and sustainable finance. despite some of the flatlining that the report by New Financial laid out, it has to be said that much has been achieved also, again, in relatively short time. Since the last European election in 2019 and the adoption of the EU Green Deal in December 2019, the EU has developed a sustainable finance framework with several milestones, and those include the EU Green Taxonomy, the Sustainable Finance Disclosure Regulation, short SFRD, and the Corporate Sustainability Reporting Directive, CSRD. And just for our international audience, these are closely interlinked, of course, and complemented by a range of investment tools such as benchmark standards and labels. Now, interestingly, a further milestone has been signed off by EU member states in March this year and is up for a final vote in the EU Parliament just today, and that is the Corporate Sustainability Due Diligence Directive. This so-called CSDDD will then require large companies to audit their supply chains to identify issues such as forced labor and environmental damage. So our next conversation will explore how this sustainable finance regulatory architecture in the European Union is likely to evolve, bearing in mind it will be under a new commission then, because we have European elections coming up in June. And the moderator for this conversation is again Harriet Agnew, the FT's asset management editor. Well, welcome back, Harriet, and I hand it over to you and your guest.
Good morning, everyone. I'm Harriet Agnew from the Financial Times, and I'm delighted to be here with Martin Spolc, who's head of the Sustainable Finance Unit at the European Commission's Directorate General for Financial Services. Now, as we gear up for the European elections in June, it's a good moment to cast our mind back and take stock of where we are on the green agenda. So, Martin, what progress has been made on sustainable finance regulation in the past 5 years?
Good morning. Thank you very much, Harriet, for having me. First of all, yes, there has been a regulatory tsunami on sustainable finance in Europe over the last 6 years. But let me recall that all these regulatory initiatives that the European Commission, together with the European Parliament and member states, has pursued have been triggered by a very strong demand by the financial markets themselves. We have engaged in a quite extensive debate with the financial sector about what needs to happen to scale up the impact on the ground. And at the time, back in 2018, we were told that there were 3 demands that needed to be addressed. First, to bring more clarity about what is sustainable. That's why we have been working on taxonomy. Second, to bring more transparency into the markets. That's why we have put in place regulatory requirements for corporates and the financial sector on sustainability performance. And then finally, there was also a demand to bring new tools and instruments that would be, again, put at disposal of the market to be used in a voluntary fashion. That's why we have done climate benchmarks, why we have done European green bonds. Now, this has been a regulatory tsunami indeed, but at the end of the day, the only regulatory requirement, and I don't want to underestimate the challenge with meeting these requirements, is disclosure. We are not forcing the financial sector or the corporates to use any of the toolkits that we have developed. The key regulatory requirement is centered around transparency and disclosures. And here we have seen that indeed, it is very costly and it is very challenging for corporates in the financial sector to comply with those requirements. And now we are prioritizing all the action that needs to be done to cut the burdens to the extent possible, to simplify, to reduce the complexity, and to support stakeholders with the implementation. My final point, a bit reassuring to all of you, this regulatory tsunami and this regulatory wave is now over. We believe that we have done all the necessary steps that, again, the sector wanted. We don't believe that more regulation at this current juncture is needed. So again, the focus is on making sure it works on the ground, there is an uptake by the markets, and that we support everyone with the implementation of the framework.
And to that point, Martin, as we move beyond regulation to enabling policies, what do you think can be done to make a transition finance work better?
Well, first of all, let me say a few words about why we are talking about transition finance. This was, by the way, not the case in the beginning of the project. There was a criticism in the beginning that we were focusing too much on the kind of dark green space, on the green finance, which is finance that is financing all of the green stuff. But we were not, at that time, as stakeholders argued, paying enough attention to what needs to be done by those stakeholders who are not yet reaching the environmental performance aligned with our longer-term target. So what basically needs to be done to recognize these intermediary steps on the transition pathways? Here, the concept is very clear. I mean, the goals are the same for everyone, but the transition pathways may be different depending on the sector, depending on the starting point, depending on the member states, on the geography, depending on the stakeholder. And here we wanted to make sure that this agenda allows everyone to improve, not only, again, those who are already getting close to the final outcome, but especially those who are operating in the industries that are facing the most significant challenges in the energy, in the transport, in the energy sector, manufacturing sectors. And we wanted to make sure that the toolbox that we have developed, again, in a voluntary way, would be useful and would be ultimately seen as something that is positive and bringing benefits. And that's why last year, to respond to the criticism that we have not focused enough on transition finance, the Commission presented a recommendation on transition finance, where we have laid out the concept, how we see the transition finance going forward, and also how the different elements of the framework can support either the companies or also the financial sector participants. We have articulated several options what both companies and the financial sector participants can do on their transition pathways, what companies can do to signal their financing needs to support that transition, and what financial institutions can do to design appropriate financing solutions, even going beyond regulation.
And now often a lot of the focus seems to be on the large cap companies. So I wondered what we can be doing to bring the SMEs into the loop.
Well, if I can be honest, this is yet another area that needs more attention, where we have not yet done the job fully, and we have exploited all the opportunities. The first focus that we are paying attention to is to minimize the burdens on SMEs. And you know that non-listed SMEs are not subject to any regulatory requirements, especially reporting, stemming from sustainable finance framework, and there are very good reasons for that, and we don't need to change that. Now, the issue is that we need to kind of avoid that there is this trickle-down effect by the companies that are subject to the reporting requirements, and also by the banks, by the investors who are keen on getting more information from SMEs. And we are aware that there are different templates being circulated to the SMEs. So it is already creating burdens on its own. So we are now kind of working on three fronts. The first front is that we have asked EFRAG to develop a voluntary reporting template for non-listed SMEs that would hopefully bring order and cut the costs and burdens stemming from any possible requests for reporting. Second, we have asked the European Banking Authority to develop ideas what can be done about green loans, because green loans, as we know, SMEs are financed by the banking sector in the first place, and we are keen on developing further instruments and further tools that can facilitate access to the SMEs. And finally, this may be a little bit a groundbreaking idea, but we had discussed it at our regulatory workshop on sustainable finance earlier this week on Monday, where we have presented together with the platform, our expert group, a proposal to develop a simplified approach for SMEs that would be, again, a voluntary tool that would be alternative to taxonomy, that would allow the SMEs to demonstrate what they are doing good for climate or environment. And that would be very simple and very easy to use. And again, that would not cause any burdens, that would not cause any any excited that the system would be complicated. So through these three elements, voluntary reporting template for SMEs, the possible follow-up to the EBA report on green loans, and finally this simplified approach for SMEs that would be an alternative to taxonomy, in our view, are very promising avenues going forward.
And can you talk in a little bit more detail just for wider companies and the improvements that you've made in terms of the voluntary tools and encouraging the market to use them?
First of all, we do admit that some of the instruments that we have put in place, and in particular taxonomy, they are complex tools. And we understand that especially the initial costs with implementing taxonomy and introducing the system in the companies and in the financial sector, they are costly. But I am very encouraged to hear what we heard on Monday earlier this week at our workshop with the platform, where stakeholders have actually reported the first tangible signs of benefits that taxonomy and other toolkits have on the ground. And we have obviously supported them. We have made the taxonomy as much as usable as we can. We have developed some online tools. We have produced new FAQs. We have tried, again, to reduce the complexity of the taxonomy wherever we could, and we continue these efforts. But what is the highlight and the key takeaway from the event that we had on Monday is that stakeholders are actually using taxonomy on the ground. And if you look at the numbers, they are very encouraging. We have seen that especially companies, based on the first year of reporting, have used taxonomy for their capital expenditure. And the amounts of investments that are aligned with taxonomy are really significant. We have seen some 166 billion euros of projects that are aligned with taxonomy. And on average, 20% of the capital expenditure of the companies in the sample are ultimately having capital expenditure aligned with taxonomy. So there is a very good trend ongoing. It's an encouraging. We are not yet there, but there are some very good and positive signs that the stakeholders are using the framework as we originally intended.
And looking beyond the European agenda, how satisfied are you with the global interoperability of the transition finance agenda?
Well, maybe on the positive side, when we were developing the corporate reporting standards in Europe, we paid a lot of attention to ensure interoperability with the international standards. And I think that we have managed to do that. And as you know, stakeholders who will be compliant with the European standards will be by default deemed to be compliant with the international standards. Now, that's on the positive note. On the less positive note, if you ask me how satisfied I am, I cannot say that I'm fully satisfied, because we still do have major differences at the international level, or lack of consensus on the importance of the key concept that is embedded in the sustainable finance framework in Europe. And that is the double materiality principle. And we strongly believe that although, this interoperability objective is absolutely key, it should not be at the expense of integrity and the credibility of the framework. This is, by the way, a quote of one of the speakers at the event on Monday, and I fully agree with that. The double materiality principle that is embedded in the sustainable finance framework is key, because as long as we have explicit targets, and we do have explicit targets in Europe for 2030, 2050, we have also now an aspiration for 2040. It is important to reflect not only how the risks stemming from climate change and environmental degradation will affect financial performance of companies in the financial sector, but we also need to look at the impact of businesses' operations and the activities, exposures of the financial sector on climate and on environment. And that's why, if you ask me on the issue of transition finance, we strongly believe that the transition finance should not cover only the risk part, but in the first place also the impact part. And that's exactly where we believe that the transition plans conversation needs to cover both angles. And for any discussion on credibility and robustness of the transition plans that are ongoing, this double materiality principle, in our view, has to be respected.
And you mentioned earlier some of the crucial sectors like transport, energy, manufacturing. Where should incentives and sectoral policies be put in place to support these sectors, do you think?
It's a very good question. At the event, to recall again the workshop of the platform and the commission on Monday, there was a poll, what basically needs to be done next. Should we need more regulation or should we do more incentives? And actually 76% of the respondents argued that there is a need for more incentives to put in place to scale up the impact on the ground. So stakeholders do appreciate the existence of the sustainable finance framework, but many have proposed, and also some of the speakers have proposed, that we need to better connect the framework with the sectoral policies and also the public money, the way how the public money is being invested and how the public money can be used either to de-risk projects or provide additional incentives to initiate projects that would have not otherwise taken place. And here I just would like to say that, and this is also what I said at the event in my concluding remarks, I think it is always important to recall what we already have. And we should not forget that this agenda, although it started before the European Green Deal in 2018, the European Green Deal came 1 year later in 2019. And the European Green Deal has brought a number of new initiatives that are providing a very clear sense of direction of travel, but also a lot of sectoral policies with appropriate funding, with appropriate public finance programs that are supposed to stimulate investments in the right sectors. So my plea to all of you who wonder, are there enough incentives, is in the first place to look already on already what exists. And in our communication that the Commission published earlier this month on the clean transition dialogues, we have made kind of an attempt for a summary of the different public programs, different incentives that are already in place that could ultimately allow for a greater crowding in of the private investments. So let's look, first of all, at what already exists. Now, stakeholders still believe that we need to do better. So the Commission is obviously listening, and we are happy to engage in a further conversation what stakeholders believe need to be done in terms of providing more carrots.
Well, that seems like a good moment to end on, and unfortunately we've run out of time. Thank you so much, Martin, for joining us today. And now back to Judith in the studio.
My pleasure. Thank you very much for having me.
Harriet, Agnew and Martin Spolc there. Now we bring it together, if you will, coming full circle to the three gaps Marcani mentioned yesterday that need to be closed in order to meet the urgency of the moment and create a sustainable financial system, a centerpiece of a net zero economy. And those three gaps, you remember, were data, action planning, and then investment. And also tying in, of course, the data that now will be gathered as part of the disclosure exercise that now has been kicked into motion with the ISSB standards and the ESRS standards in Europe. And so we will turn it over back to the financial industry to look into which technological innovations, such as AI and blockchain, are being deployed to crunch that data, to analyze it, to add transparency, meet those regulatory requirements, and also assist decision-making in sustainable investing, and what the caveats may be. And this final conversation will again be led by Simon Mundy. He's the editor of the FT's award-winning platform, Moral Money. Well, welcome back, Simon, and I hand it over to you.
Thank you very much, Judith, and hello again, everyone. It's a really important subject, as Judith says, to be holding this final panel on. It's a subject that's had a certain amount of hype, but it's one that has undeniably huge opportunities for those operating in sustainable finance. a great panel to discuss this with me here today. I'm joined by Matt Christensen, the Global Head of Sustainable and Impact Investing at Allianz Global Investors, Vincent Gusdorf, who's the Head of DeFi and Digital Asset Analytics at Moody's Ratings, and Amantia Muhedini, who is the Sustainable and Impact Investing Strategist at UBS Wealth Management's Chief Investment Office. So, Amantia, to dive straight into it, I'd like to put the first question to you. How do you see technology already reshaping the work that you're doing? How does it mean that your job is different from how it would have been, say, 10 or 20 years ago? And how do you see it progressing further from here insofar as it affects the work that you do?
Thanks, Simon. Pleasure to join. And I'll say, I don't know that there would have been a role 20 years ago for a sustainable investing strategist specifically. So really, I point that out to say that this industry, finance broadly, but sustainable finance keeps changing and it's evolved a lot in the last 20 years, and certainly in the last 5 or 6 years. I'd say one of the areas that we're seeing is consistently this focus on more data. If you ask any impact or sustainable investing strategist, will they change with a magic wand? Other than climate change, they probably would say, well, give me all of the data that I need to make informed investment decisions. What we're seeing currently is a very rapid alignment on methodologies, on how to measure and how to think about unquantifiable things. And in addition, that is feeding and leveraging some of the large data processing capabilities that exist. So I'd say that's one big change. And I think specifically a second thing, which we maybe cannot do quite yet, but we have line of sight in it potentially evolving the next 2, 3, 5 years, so near future, is using technology to give us insight on what companies are doing without companies telling us that they're doing it. So gathering and validating what companies actually report by sourcing through real world or alternative sources of data and then putting it at our fingertips.
That's a really important point, isn't it? There's been a lot of emphasis on disclosure by companies, but as you say, technology is opening new opportunities for investors to cross-check what they're hearing from companies, or indeed get wholly new sorts of information that are separate to the kinds of information that companies would be disclosing. Matt, how about you from your point of view and your company's point of view as an institutional investor? Would you say that this is really bringing about a paradigm shift in terms of the kind of data that's available to you and the ways in which you can use that data?
Thank you, and great to be here. So I like the 20 years ago viewpoint because I've been in the industry for about 20 years and seen a massive change in the availability of data. And as an asset manager looking at sustainability, this has often been the challenge that we're faced with, which is how to find tangible, reliable, and comparable data. And what I'd say is where we are today is that we're able to look at the data providers that are out there, and there are many, and it's much more with an ability now to look at historical data and massage that information to help our investment managers to look at it and think about how to make more of a transactional approach to using the data to thinking about investing. And that was not available 10 years ago, it was certainly not available 20 years ago, and still not available in all forms of asset classes. And so in terms of data and where we are today, we're most able to look at sustainability and the information set with the public markets, where we have more of a reliable approach to data providers and be able to cover the wide array of different asset class market caps across geography. Where we're still having, I'd say, the struggle, and this is really, Simon, for the next 5-10 years, is about the private market. We often talk about impact investing. And the private market side, it's still very much having to inform ourselves and do that research without the proper tools of data sets that are widely available. And so I'd say that's the next frontier. And we're doing a fair amount of investing in the future data providers that I believe will start to bring in more unstructured forms of data that we can use across our own different investment asset classes. But we're not there today. We have public markets covered. Private markets is still a work in progress.
Thanks so much, Matt. Vincent, coming to you, as well as your work in DeFi and digital assets, you also head the AI analytics team over at Moody's. And that is obviously the big hot topic of the moment in tech, in sustainable finance tech, as well as pretty much all areas of tech at the moment. There are still plenty of skeptics out there who say that, well, although the things that AI can do are incredibly impressive, it's not necessarily that useful to everyone in their work. How useful do you think it's proving to be and will prove to be in the future in sustainable finance?
Yeah, no, it's becoming increasingly helpful. I think that there's no denying that. Well, I heard one participant saying that he's been around for 20 years. I've not been around for that long, but I can tell you that AI is a technology that's been around for more than 2 decades, definitely. So we do have also a certain degree of track record. To us at Moody's, it's really about finding the balance between moving quickly enough so that we remain relevant in the financial sphere and moving forward in a way that will enable us to control all the risks that could arise with the AI. Specifically, when we think about AI and sustainable investments, it can change the landscape in many, many ways. First off, it's very important in the data ingestion space. Now, when we look at what companies are telling us, we're now in a position to compare their message to what we're gathering from other type of data sources. Unstructured data is becoming clearly incredibly important for us. Another area of interest for the organization is how we're going to capture this data, put it into models, and generate insights that analysts will be able to understand. At the end of the day, we are convinced that the humans will remain probably the key decision maker in the overall process, and the machine is here to support the human and enable us to reach better decisions. When we think about ESG from that perspective, I think there's one event that comes to mind. It's about Vale, the mining company, which suffered in 2019 from a rather horrendous accident when one of its dams collapsed and flooded an entire region. At the time, I think that everybody was taken aback by this incident. I would say that today, many market participants would be in a position to better understand the repercussions of such an event thanks to AI. Thanks to AI, you can now look at all the assets that a company has around the world, and you're able to assess their effect on the community, on the environment, by looking at new kind of sources like satellite imagery or web scrap data.
Thanks so much, Vincent. And I'd really love to hear from Amantia and Matt too about the ways in which you're perhaps already deploying AI in meaningful ways in your work. You see the potential to do so in the future. I know that personally, for me as a journalist, I find ChatGPT incredibly impressive, but I haven't yet found a particular use for it in my work. Amantia, is it different for you? Are you finding various AI tools useful? And do you have a strategy within your team to use it more in the future?
I'd say we're very much, the broader Chief Investment Office team is looking at how we can leverage AI to just make us better analysts, sustainability aside, right? I can't say that we have quite cracked that nut yet, and it's probably the right answer for everyone in the industry. As these models evolve to help us who are not technology professionals, we're generally optimistic that we'll get there. One of the areas that we're thinking about in the sustainability team, however, is also what are those potential downsides or risks or things that we need to prepare for now before we're ready to fully deploy all out. So that's another conversation that is worth having, I think.
Thanks, Amantia. And Matt, how about you? What's the AI strategy in particular for you guys at Allianz?
I think that, in a sense, what Amanda has said is probably indicative of the industry of financial services and how to best use the tools. I'll give you the 2 use cases that we have seen start to give us some added value. The first is the data scraping. And so when it comes to data scraping, we have definitely focused on the news flow. The news flow has been on aggregated information beyond sustainability, but then we are narrowing that into what part of the news flow can be useful to us. And that might be about seeing stories. And I'd say the first area of interest is controversies. And so where there are controversies that come up, the news flow moving from what was more of a reputation system, that was call that version 1, to more about thinking through the automatic extraction of information of controversies from an external source and creating summary descriptions. That's where you start to see AI come together and start to give what I think of as a first version tool that gives us a dashboard that we didn't have in the past. That's number 1. Number 2 would be on the natural language processing. On that one, it's going to be now we have a project about linking words, and I'd still say it's in the early areas of innovation. Environment's been easier than social and governance for us, but on looking at how to link words to the guiding conclusions to help us with sanity checks, to help us prepare our engagement with companies on using that tool, that's giving us a bit of a test and some tests that are helping us to think, oh yes, we see where the future is going, and that if we're at version 1, we could already start to imagine version 3 is going to make us much more efficient and change the way our jobs work. And I think that's what everybody's waiting on, is about how will the jobs that we have in our companies as analysts, as looking at sustainability information to make investment decisions, will become more efficient. And so between the scraping and the natural language processing, I think we're in the earliest stages of starting to get hints about how that will make us more efficient. But right now, it's again going through and testing by error about which is working and which are leading to cul-de-sacs that are more about that one didn't work, let's try something different.
Thanks so much, Matt. Vincent, as you know, there's a lot of concern among a lot of people about the potential risks surrounding AI. And we all saw that rather scary one-sentence statement that was signed by a whole bunch of AI experts warning about the potentially existential risks surrounding AI. So if we set aside the existential risks and the risks of a Terminator-style disaster and just focus on the sustainable finance angle here, nonetheless, perhaps there are specific risks related to what sustainable finance professionals might be doing here. What risks do you think people should be aware of when it comes to AI?
There are many risks to consider when you're deploying AI tools. They are ranging from, let's say, incorrect outputs to technological risk, and not to mention the risk of vendor dependencies. So there are many aspects that needs to be considered. From our perspective, to handle a transformation such as AI, it's important to set up a comprehensive plan that's going to focus not only on governance and strategy, which are often talked in conferences and in newspapers, but it's also about setting up the proper technological capabilities that will enable companies to control and scale the models. To give you one example, there's been a lot of talk about AI since ChatGPT was launched 2 years ago. But essentially, AI has been around for quite a long time before this announcement. The reason it doesn't gain traction is because companies have not been able to scale AI models. There are a number of issues that pertain to AI models that are very specific to this technology. Those models tend to see their performance deteriorate very quickly, for instance. Or the data that you're going to ingest may change, and therefore you need to adapt your pipeline if you want to keep a model that's performing well. So it's also about being able to handle these scalability challenges. From our perspective at Moody's, there's another very important element to consider here. It's about understandability. You can have the best model out there. People will not use it if they cannot understand it. And that brings me back to what I said earlier about technology empowering human. Ultimately, we should bear in mind that it's humans that are going to keep making the important decisions, and they need to understand how a model came to a conclusion. If it's only when they'll be able to understand the strength and the limitation of such tools that we think AI will bring its benefits.
Thanks so much. Another important thing that people in sustainable finance have to think about with regards to technology is how much technology investment you do in-house and how much you make use of this enormous and growing number of specialized tech companies, big ones, small ones, in all parts of the world that are now lining up for your business. Matt, how do you and your team approach this? How much investment do you want to do in-house in tech solutions, and how do you decide which, if any, of the external tech providers to make use of?
I appreciate the question because it is a big challenge about the sort of black hole of cost on tech and how to think about best being strategic around it. And I'll give you maybe a facet of how we've done that working with technology that's third-party data, and how we're also thinking about this from the investment set of looking at data in our private market platform. On the former, we are working with more than 10 different data providers, and they specialize in various aspects. Some are very wide, some are very narrow in terms of key performance indicators on the future areas of sustainability. I'll give one example, biodiversity, and how to think about the use of the work that they have done on coverage and the thinking on their algorithms that we can put into portfolio construction or even research that helps generate ideas for our engagements with the companies that we might invest in. Call that one area that we're using as data that we bring in from external providers, massage it, and then put it into different types of scoring systems, key performance indicators that go to all of our front office systems. That is a multi-million-dollar piece of work that we have done to create that kind of flow of information that has a modular element. The other part to your question, Simon, is about looking at all the data coming and how to think about, is there a way for us to be getting ahead of it and learning by investing in it, seeing how it's being done successfully with different types of clients? And so we think of that as data as a service. And so we are looking at investing in different types of more unstructured types of data, more future-oriented data that we're doing in our private market impact investing efforts. And that has been a tool for us to learn. And that's when I go back to the earlier question to think about when we invest in some of these different data solutions, how might we envision the way that might shift our own workflow over time? So I'd say, to be now shorter in my answer, we have a whole data technology team internally that looks at the massaging of different sets, and then we customize that to the needs that we have as investors. And that's where we bring the outward external side into an inward flow that is what we believe will bring us that investment risk return performance we're looking for.
Thanks, Matt. Amantia, is your approach similar, or does it differ in some important ways?
Yeah, I mean, Matt could have been describing the UBS approach. And so the only thing that I'll add there is, yes, we also have the same approach here. We're looking at a best-in-class kind of vendor selection when it comes to ESG data specialists. We don't need to go and come up with a way to identify biodiversity metrics. However, once you do have these many specialists, then you have this unique challenge of reconciling what they're telling you. And all financial institutions are coming in with a point of view here that is going to be important to Vincent's point of the human needs to stay in play. One very specific example of how we see this play out, even when you think of controversies, which are facts, something happened that was documented. Let's say a company was sued by a local government for something in relation to labor rights. Multiple data providers could pick that up, that we could receive that information. However, the documentation on how deep this issue was may vary, and also our point of view and the data provider's point of view on how this will impact the financial performance of the company and how it impacts negatively the local community, as well as how long it'll take to resolve three variables, right? Those things will be distinct. So our efforts internally are very much on investing on sort of aggregating, making sense of, making decisions on these raw data points that we're sourcing. And that there's friction in there. We definitely don't want to make it look like it's something that is easy to do, but the value will come out of that kind of viewpoint being developed, I think.
Thanks so much, Amantia. We are nearly out of time, but before we finish, Vincent, I do want to talk to you and get your perspective on DeFi, digital assets, something that a lot of people are working very hard on, but a space that's really had a tough couple of years, at least in the media and places like the FT, coverage of things like the downfall of FTX. Specifically when it comes to sustainable finance, what do you think DeFi and digital assets have to offer?
Yeah, great question. I think we should make the difference between cryptocurrencies and the underlying blockchain technology. Cryptocurrencies are volatile. They are subject to a number of controversies. We tend to park them aside and really focus on what you can do with the underlying technology, which is really about providing a way to store information that you can trust. For us, that's very important for the sustainability aspects of finance. There's been a lot of discussions around the quality of ESG data, and many participants here mentioned that they were dealing with multiple data providers. It's typically a very good use case for blockchain. Blockchain essentially is really about storing information in multiple places and ensuring that what you're going to store is going to be accurate. For ESG data, it can act as a source of truth. You can have theoretically one blockchain on which you will put your data in a standardized manner. Then all the participants will be able to access this data and ingest it in a way that they will be able to turn into actionable insights. So at a high level, that's the direction of travel for blockchain in the ESG space. Now, when we think about the concrete implementation cases, we do see a number of very interesting initiatives. Just to name a few of them, digital bonds are very interesting. You can combine this technology with the Internet of Things to bring sustainability information directly to investors. That's what we've seen in a digital green bond issued by the Japanese company Hitachi, for instance, last year. In this transaction, the issuer plugged sensors monitoring energy savings directly to the bond platform, and therefore investors were able to access in real time information about how the proceeds of the bond issuance had been used. To give you another example about the benefit of blockchain, we can look at supply chain. Supply chains are extremely complex. They are responsible for a great deal of total greenhouse gas emissions. With blockchain, you can map the journey of a product. And when you're going to be a customer, and when you're going to buy this product, with blockchain, you'll be able to see which phases this product has been through, and all along the journey of this product, how much pollution has been created. A concrete example, for instance, can be found in the blockchain platform that has been set up by the automakers Hyundai and Kia. They've created a platform that does exactly that. Similarly, Starbucks, the chain of restaurants, has created a blockchain application that's tracking the sourcing of coffee beans. And there are a number of other applications of blockchains for sustainability. So we do think that it's a very promising technology.
Thanks so much for that. There's clearly a lot of things for me and my colleagues at the FT to be following up on from this conversation. We've really covered a lot of ground on a subject that no one operating in this space can afford to neglect. Thank you very much to all the panelists for a really interesting conversation. Thank you, everyone, for tuning in. Back to you, Judith, in the studio.
Thank you kindly, Simon Mundy and his fantastic panelists, Amantia, Muhedini, Matt Christensen, and Vincent Gusdorf. Well, that's just about time to wrap this up. Over the past 2 days, we covered many ideas, challenges, potentials for a reality check on sustainable finance. I have to say personally, I feel inspired, and listening to all our experts has left me very hopeful about what's to come next for sustainable finance. I do invite you to listen back to all the conversations. They're already online. The replays are online on the website of Luxembourg for Finance, where you can easily listen back. Special shout out goes to the team at New Financial and William Wright. I think they've done a great job in giving us a true reality check on green finance 2.0 over the last few years. Again, I encourage you to read the report. It offers great insights and pointers to bring back that momentum that also Mark Carney spoke about. As he said, building a sustainable financial system as centerpiece of a net zero economy is not a panacea. It's doable with all the tools we have at our fingertips. And think of some of the innovations that are coming down the pipeline, as our technical panel just discussed. And as Uli Grabenwarter said this morning as we kicked off, let's think more about impact. Let's extend the horizon a little bit into the future beyond those 12 months. After all, those are also our climate goals that we set in the future, and we need to think towards them and then think backwards and build the solutions to resolve the problem. After all, finance is excellent at extrapolating data, making sense of potentials given also the new technical tools. And with that, I want to express a heartfelt thank you to all our speakers and moderators for setting aside time to join us, to our sponsors and our media partner, the Financial Times, and to all of you who have been joining us from around the world to listen and pay attention. And I think all of you wish you very well for the rest of your day, and take good care of yourselves. And I see you on the path to net zero. Thank you and goodbye also from our team here behind the scenes.